Mastering the Art of Investing.
Hi, can everyone hear me okay? Man, these lights are bright. Okay, great. So we are all here on this panel, which talks about mastering the art of investment. Whether art, science, or magic, there's no doubt that investing is a highly marketable skill. And I'm very fortunate to have with me on this panel people who know a thing or two about investing. We have Vikash, we have Anand, Joseph, and Shafaat. I think we should do a quick round of introductions. I'll start, get the boring stuff out of the way. My name's Shantanu Mukherjee, Shan. I run a boutique law firm called Ronan Legal. We advise investors and entrepreneurs in life sciences, healthcare, medtech, health tech, in complex cross-border transactions, venture capital, private equity, mergers and acquisitions, in licensing, out licensing, down to clinical trial agreements, supply chain agreements, clinical development, all of that. I'm qualified in the US and India. We have offices in Dubai and India. I think Vikash, and then we'll go down this way. Vikash, do you want to talk about yourself a little bit and what you do?
Hello, everyone. So I represent a corporate fund called IC1101 Capital. We majorly invest in healthcare, energy, food tech. These are our prime three verticals. I personally represent the healthcare verticals, and we have been into hospital management. We operate and manage hospitals with a size of 100 to 200 bedded. We have run many hospitals since last 10 years. And then we have pivoted to more of investing into health tech startups. We have done few acquisitions as well. And yeah, this is a short introduction.
Hi, good morning, everyone. Thank you very much for giving me this opportunity to be here. My name is Anand Govindaluri. I am the founder and CEO of Govind Capital. We are a venture capital firm based out of Singapore with interest to invest in Asia, Europe, as well as in the US. And the reason I'm here is because I'm looking to expand our venture investing business into the UAE. I've been in the business of investments for the past 20 years. We have invested in 70 early stage venture, life sciences, biotech, medtech, healthcare companies, and of which we have lost money in 23 ventures. That's something which I would like to share with everyone. We made money from 25 successful exits, of which 2 have been unicorn exits. And I'll speak more about that as we go along. Our focus is basically to look at founders who have the capacity to scale up businesses in a relatively short period of time. So when we come in, we are active mentors. We help them to scale up, and we also help them to essentially plan for the next big exit in a span of about 3 to 5 years, which is relatively unheard in the medtech field, but that's what we are specialists in. We have a global pool of mentors, and we have partners from big corporates such as GE, Wipro, and so on and so forth. My background is I'm a medical biotechnologist by training with a layer of MBA in finance. And I served on the advisory board of Singapore MIT Alliance for Research and Technology, which is MIT's first overseas presence in Singapore. I'm also on the advisory board of management institutes. I'm on the board of directors of universities in India. And my role as a board director and advisory board member has been to actually facilitate founders to get access to capital, to mentor startups, to mentor founders in terms of their ability to build successful bio enterprises. Thank you very much.
Thanks, Anand. Joseph?
Good morning, everyone. Thank you for the invitation and being part of this panel. Happy to have this debate about MedTech in Dubai. I'm Josep Sanfeliu, managing partner and founder of Asabis Partners, a venture capital firm based in Barcelona, Spain. We are a 250 million euro management company in 2 funds. I've been in the business career of venture capitalism since for the last 15, 16 years. Most of my career 80% as a venture capitalist has been investing in technology and medtech throughout Europe, mostly, US sometimes. Our focus at Asabis is 50% of what we do is investment in Spain, medtech, biotech, digital health, and 50% is outside Spain. I'm impressed with the potential of the region in terms of adopting technologies, and you guys have an opportunity to do things right from scratch and to start in the right way, especially when the technology is coming up. So it's delivering an opportunity for developing and incorporating the technologies that we invest in. So I'm really happy to be here today and to be exploring for the next days. I'm staying around the area for the next days just to explore opportunities. Asabis Partners is a venture capital firm. We've been in the business now for 5 or 6 years, and I have to say that our focus and our birth, I was with a previous firm which was doing mostly biotech in the past. In my career, I've sold companies to corporates, Abbott, St. Jude Medical at the time, to Cliogen. I took companies IPO in NASDAQ, always in medtech for my last 15 years. But in the last 5 years, Asabis Partners has been focusing on medtech, mostly on digital health. Why? Because we were one of the few European VCs that remained investing in medtech. And why is that? Probably you know about the regulation in the European Union. It changed in the last nearly 10 years, the last 7, 8, 9 years. We had the directive that moved into regulation, which under European law means that really you have to apply it throughout the continent. It's not each country to develop its own legislation. So that created a whole change in the regulatory process and CMARC and notified body structure of the European market. That represented an opportunity for some investors, like Asabis. For some other investors, it represented a huge crisis, and many European VCs stopped doing VC medtech investment. So I'm proud to be one of the remaining firms based in Europe that we're still looking actively at the medtech investments. It's a good opportunity, and going forward with integration technology, I think it's great for Asabis Partners, which I represent today here. So thank you.
Thanks, Joseph. Shafaat?
I'll try to keep it short, you know. We have a different edge. I'm more of an innovestor because we innovate with founders alongside more as partners. I have an investment firm based out of Abu Dhabi, DC, and Zurich with over 500 million AUM, and then over 20% goes into VC arm. We have about 7+ operating funds as we speak. But what we bring on the table is that we do have our own go-to-market brand marketing agency with 14 international offices, over 300 people working for us in these offices to really scale a business and startup and globally. I mean, it's literally one funnel. You drop something and it blows up. We have been in the business for the last 20 years now. I sit as a board member on 29 different startups, personally as an accredited investor, and then we have quite a portfolio when it comes to real estate others. Moreover, I have a company in Silicon Valley, so we do provide tech support. So literally when we invest, the founders really don't have to go nowhere. You know, I've got everything in-house. And we try to maximize, the economies of scale by sharing key core resources that a typical startup cannot afford, by just providing them one single platform where everybody has a shared access along with our capital, connections, network, so on. I sit as an LP on 3 different funds, and truly honored to be here. Looking forward to a great discussion. Thanks.
Terrific. Thanks very much, Shafaat. So we have a fantastic panel here, and when we talk about medtech, sorry to be a lawyer about this, but let's just define what medtech is. You know, we're going to be talking about medical devices, implants, robotic surgery, AI as a medical device, all of that, right? Now, I'm very interested in talking about this because we are at this point of time at a very challenging time for the VC industry in medtech, right? Over the last, I think this year we saw an 18% drop in VC funding year on year from last year, and we're down about more than 50%, depending on which whose numbers you look at, but we're down more than 50% from the height of VC funding for medtech in 2021. So these are tough times. The IPO market is frozen, inflation's high, interest rates are high, M&A is down, 30% of all deals done last year in M&A were But down rounds, there were only about, I think there were only about 46 deals that were worth more than 100 million that were completed by 23. Aggregate proceeds of only about 33.7 billion. So things are not looking good out there, right? Increasingly, 5110K pathways are preferred to the PMA, which tells you that people are not taking chances on innovative products at this point. So it's a difficult time, and it's a great time for us to talk about these things. So how we're going to break this panel up is we're going to follow the classic fund model. We'll talk about fundraising first, then we'll talk about selecting and executing deals, and then we'll talk about exit. So without further ado, I think let's jump right into fundraising. One of the key things about fundraising in MedTech is, of course, you need to have patient capital, right? Vikash here represents the classic kind of founder that you want in this industry because he's a strategic, right? He's looking for companies that supplement his strategic marketing, his strategic position. He's looking for portfolio companies to feed his pipeline, right? So Vikash, very quickly, do you want to talk about how fundraising is different in this environment? Of course, you're not really looking at fundraising because you're deploying proprietary funds. So maybe we should go to Anand to talk about fundraising in this environment and how difficult it is.
Fundraising is an art. It's like, I believe that in the past 20 years, 25 years of business of investments that I've been, I think if you know how to share your vision, you will get a way to raise capital. Now, most of the times, what happens is that getting the right investor is extremely important. A startup founder is dependent on getting the right investor who understands the space. Let's say, for example, because many of the funds that are raising capital or many of the startup companies that are raising capital, they approach funds which do not have the sector focus. So I think while there are very few life sciences venture capitalists in Asia, so we are slightly at an advantageous position because of our background in life sciences and medtech. But many other funds that I've come across are sector agnostic, and they're generalist funds. So when you are a generalist, you tend to invest in those areas where you get a higher ROI. Whereas in our case, we do not put an ROI clause or an IRR clause in any term sheet. What we do is we try to understand what is the value that we can bring in on the table as an investor to the founder. And for the founder, what is important is he or she needs to demonstrate the ability to scale up the business. Because once you have the ability to scale up the business in whichever market you're present, then it becomes easier for the investor to guide you and to add value to with respect to specific connections, specific business opportunities, business partnerships. So while in general fundraising may be tough, the key thing out here is learn the art of articulating the vision and getting the right investor across.
And for your fund yourself, Anand, who do you bring in as LPs? What sort of capital are you looking for?
Our fund is based, we are an 8-year-old fund. We started in 2014. We were fortunate that during the time when we were raising capital in 2014, we had access to capital from Europe as well as from US. And our story was connect the bridge between the West and the East. So while we have a policy, while we have a focus on investing in companies in India and in Asia, but the value add we were bringing on the table was European companies, American companies which want to come into Asia, they could use our capitals, which is more like a smart capital for them to get into the market. And that doesn't mean that we don't invest in those companies if they're not expanding into Asia. So we do selectively invest in those opportunities also. But more importantly, for us, it was easy to raise capital then because of the fact that Asia was rising way back in 2014. If I just give you some stats, in 2014, the Sensex, which is the stock market in India, was below 15,000 points. And today, if you look at the Sensex, it's much above, way higher than 15,000 points. So it also shows about the growth. So, I mean, IMF projections are quite visible out there. They say that India is likely to grow anywhere between 6 to 8% year on year, whereas when you're looking at other countries, the growth is somewhere between 0 to 2% or 0 to 3%. So I think there are several advantages of focusing on India, but we just don't look at India, we look at Asia. We also look at investing in US and European companies which want to expand into Asia. So that is what makes our fund a bit special. So it's very important to have your own USP, and that USP is what you have to articulate while you're raising capital, be it for a fund or be it for a startup company.
Yeah, India hasn't suffered in quite the same way as Western economies have over the last couple of years. But Joseph, I'm looking forward to hearing what you have to say about fundraising. I know you've been very, very vocal in the past about the importance of strategics.
Yeah, let me see. Yeah, fundraising is an art, but this fundraising also a high-risk sport. You need to practice, you need to be out there, you're always fundraising. And without regard, I've been fundraising since I started my career as a VC partner in 2008. Actually, I have an anecdote, which is on the 12th of August of 2008, I was in Dubai when I got the papers to sign for our first fund. It was roughly 70 million euro, that was 2008. A month later, Lehman Brothers and the world came down, so that was like high-risk sport. We were able to invest after that, which was great because the vintage of that fund went great. Company I was dealing with, one of my investments, went IPO years later in NASDAQ for a neuromodulation device for hypertension and heart failure. Great company with a great team, European, US, and several other good successful stories from those years. And then we
Did
kept...
you find some bargains? Did you find some bargains back then?
No, I mean, one of the risky side of that is that you're getting to the limit. Your road shows are super stressful because you know something is coming up. There was available money, and we were able to raise. And then, obviously, valuation 12 months later went totally down, right? And this is 2008. Our first fund was closed in February. From Savis, from this new firm I founded in 2019. Our first fund, the closing date was roughly February 2020. So again, at the edge, right? And then we saw the closing of the markets, the closing of our lives at home through COVID, and then the exuberance of 2021, which was crazy by all means, right? And now we are facing 2022 and 2023 post-exuberance. So to your point, fundraising, how I see it, how has been evolved, and what LPs and what type of, let's say, animals we found now in the jungle of doing and dealing with money makers, money owners, whatever you want to call it. I think that there has been a rationalization with what I'm feeling now. We are fundraising and finalizing our current fund, which is at 200 million. We are at 160. We are still seeking for our last 40 million euros to close the fund by July. And we are visiting investors of different sort. And if I compare to what I experienced in 2008, in 2014, in 2019-20, when I was fundraising over the course of the last 15 years, I've been working in this. Now I'm starting to see very interesting moves. So I feel the sustainability of businesses like healthcare and medtech and the fundamentals, they're so strong and so sustained that the category of healthcare is being taken very seriously by investors that are part of the ecosystem. Before, and in other industries, if you do real estate, if you do even tech, or if you do other types of investments, what I feel is that there's a disconnect. So the purpose of the investment from a financial investor into a fund is basically financial, which it is also in healthcare. Let's not forget that. But there's like a second dividend out of that investment, which has to do with purpose, responsible investment, connection with something that has business fundamentals based on epidemics, based on unmet medical needs. So now the surgeons of LPs that in the last 12 months have become investors of ours, Savis, these are corporates from the industry. they were already there. We were investing alongside with Novartis, Roche. We've been investing with Pfizer for the J&J. We have portfolio companies with co-investments with all European and US companies. Obviously, we've been working together with them very tight. But now you see them invest in funds. We have one of a huge corporate, 50 billion market cap quoted company that invested 10 million euros in our company, which was unprecedented in the past. It's the third investment they do in the last 12 months, never had invested in funds as LPs. This is one movement I've seen, I see, and I'm capitalizing on that because it makes a lot of sense. We talk the same language, we speak the same language, they get access to external innovation. There's lots of strategic reasons to do this. The second thing is that we see also the rise of family offices. Family offices together with advisors, together with other investors that know the business but have a connection to healthcare. We have investors that are family offices around the world that have healthcare businesses. And their operational businesses are healthcare. We have an investor from Mexico. These guys are running most of the pharma businesses at different levels in Mexico, and the family office is investing in healthcare, not the pharma business, but the family office. So to your point, I think it's an opportunity to fundraise with a different sort of more connected, where the discussion is more connected to healthcare and to the fundamentals, which makes our life easier because when we go and talk to them, we speak the same language. We have the same discussions, and they understand the fundamentals. Different stories, track record, which is everything, it counts, at least in our belief, obviously. Management team, everything they have to obviously demonstrate. But I think the profile is changing. So family offices with an interest in healthcare, sometimes it's not because they're in the business, but just because they are sensitive to the purpose of investing in things that do good for the world with a return, financial return. And the second thing is the integration of the industry.
Okay, excellent. Yeah, family offices are huge, particularly in this part of the world, in venture capital in general. And another thing about this difficult investing environment, as you said, as you pointed to, is that it's driven out tourist investors. Now only the insiders have remained in the game, the strategics. But Shafaat, any thoughts on fundraising? We'd love to hear from you.
Yeah, I think Joseph and Anand has added so much value. There's not much left to add. But I'll rather speak from a different perspective, because fundraising is not what it was 10 years ago. It has evolved, and we need to understand the changing landscape, the changing sources, the new financial instruments that are out there. And a founder really needs to understand it. I mean, I can talk about how we raise funds, but I think founders and startups should respect the investors or VCs like us, because that's what we do for a living. So maybe just learn from us how we do it, But at the same time, we need to understand that, yes, sector-focused funding is fantastic, but at the same time, there's something known as a family office and something known as a family business. And there are a lot of family businesses there who don't have a family office, but still they're looking to diversify their portfolio and their aspirations. Moreover, we also need not to ignore impact investing. That hasn't been really discussed by far. But there are social enterprises, especially when I talk about healthcare and medtech. We need to understand the social impact of it. And it's not only about the money-making idea, but there has to be some social link to that kind of investment, which to me gives an idea that yes, there's a lot of taxpayer dollars money which is literally lying on the table, especially in the United States, even in Europe and many other countries. And that money needs to be parked in something known as education, healthcare, and some of the basics that humanity needs. And that needs to be leveraged essentially with VC firms or investment firms like ours and all of us together to create that unique mix, a complex mix of capital and a cap table, which is looking for an impact, which is looking for a profit, and still gives a great exit, but at the same time serves humanity. So for anybody fundraising, I think that's the kind of mix we should be looking at.
Excellent point, excellent point. So to summarize, family offices, impact funds, strategics, corporates, they're all in the mix. Tourist investors have been driven out, and you're more likely to double down on your existing portfolio companies than you are to seek out new bets. Certainly avoid seeking out risky bets, which brings us to the next phase of the conversation, which is how do you select and execute deals? right? What for each of you, what founders and companies do you choose to back in this grim environment, and why? Which subsectors within medtech, do you think are doing well? Robotic surgery, AI obviously is all over the place. Neuroscience is getting a lot of traction. Wearables, ECG wearables in particular. And how is executing a medtech deal different than in other sectors? Vikash, we'll come to you first.
Thank you. So we have a different perspective as a corporate fund. I'll tell you the reason why we jumped into health tech investments. We used to run hospitals over 10 years. We have run many hospitals. And while we were running the hospitals, there are so many startups who used to come with the solutions. Technology, innovation, I mean, they tried their best. I'm talking about, 5 years before, or even 3 years before, even 6 years before. Um, we used to encourage such technology, and then we used to try to implement those technology into our hospitals. But we saw one bigger gap is the adoption. So there is a lot of innovation in the technology which are keep on erupting. I mean, after COVID, I mean it has gone tremendously spike in the innovations. But in ground, if you see the reality, because we are a clinical people, we are running day in day out of the hospitals. So when you see the adoptions in the from the healthcare stakeholders perspective, especially the hospitals and the patients, we talk about the technology, but when it comes to the adoption, there is a gap. And that reduces the scalability, as well as from the innovators and the startups perspective, they haven't got an opportunity to enter into a hospital and see the dynamics, what is going on in the ground reality. That creates a gap in terms of adoption, and that reduces the scalability. So this is something which we realized, and then we created a stack, and that's where we pivoted into smart hospitals. We knew that whatever is the requirement, and what way we can ease the adoption to the stakeholders, and that's why we jumped into smart hospital. Currently we are the largest smart hospital chain. We run 300 smart hospitals, and then the investments and the choice of the startups which we selected and then we acquired, we gave the platform where and the perspective and the thought process that how the technology can be tweaked in a realistic manner and then can be adapted, and then the scalability can come. So this is how we always see from a startup that what is the adoption ratio, and then we measure the scalability. We can see many valuation projections, we can see number of users, we can see downloads, we can see excellent technology. But we always see from a corporate fund perspective that what is the adoption ratio and how much sustainable it is going to be. Because if you see the track record of many SaaS based medtech startups, they force, or they can advertise and they can enter into, or they can sell, but their sustainability period is very limited. And that is where the gap we see always. So we see that whether it is AI, wearables, or any new technology which is coming up more and more, there has to be adoption. And if you see the statistics on majority of the funding, it is going towards the personalized care, because the care towards the data and the technology is getting personalized, and that's where the acceptance is from the user point of view is increasing. So this is where we tend to look out from the startups, that what is the adoption ratio and how well we can merge it into the technology and give our experience and the platform, so that even if we acquire or invest, we can create an angle more towards the sustainable point of view, so that the startup can grow and even it is more easier for us to exit.
So Vikash is a classic strategic, right? What he does is he has the ability to scale your product. So he's the kind of investor that you want if you're a SaaS-based product, if you're a health tech player, maybe ERM. because he not only gives you the funding, but he also gives you the ability to commercialize, scale, determine whether your product's sustainable, what's the rate of adoption. He's going to promote adoption. So he makes a great point. Anand, how are things in Singapore? What kind of founder, and India, of course, what kind of founders do you like? What are you seeing in the market? What kind of deals are you doing?
So it's a very interesting question. Let me just give you a practical example of two investments I made recently in Singapore and two companies which I invested in India. So I'll begin with Singapore. In Singapore, the two investments I made recently were, one is in AI of mental health, which is using the AI technology to identify, to screen and to diagnose mental health issues earlier in the game. It's also basically culminating between mental health and longevity and addressing a little bit on the aging issue. The other company is in the biowearable space, biowearable for knee pain management and orthopedics. Now, in both these investments, in fact, I'll go a little bit deep. The relationship with the founder is extremely important. What really struck me when I made the first investment on the mental health company was the access to data. The due diligence is very sacred for me, and so the data room and the diligence kind of information that was put in the data room was so diligently put. It was so comprehensive, including the bank account statements the founder had actually put in the data room for me to go and see where they were spending money. So that kind of transparency, if a founder is able to bring in, because then it gives a lot of trust to the investor to take a bet in an early stage company. So we made investment in this company, and about what happens is after about a year, the company runs short of money, or after a few months, the company runs short of money, and they come back to me asking for more money. And that's when I was asking myself whether I should put more money or whether I should stop and look for somebody else. But then I told myself, these guys have come working so hard. I've been having weekly calls with them, strategy discussions, strategy meetings with with the founders, not just at the top management level, but also at the middle management level. So I know the team quite well. So I decided to put more money. And then we worked with the startup company to raise capital with other investors. And recently, the company raised about $15 million from some Japanese investors and other investors in Singapore. So my valuation, in fact, actually is already on the book value, is already about 3x or 4x in a span of about 18 months. So this is a classic example. So it depends a lot on the founder. When I look at India, I invested in a cancer testing, cancer diagnostic company where the founder, it's a Series A company, but interestingly, though it's a Series A investment, the company was able to raise $60 million, and they got some very good corporates from India as well as from the US, including Mayo Clinic, to invest in the company. It was
This is
Mayo Clinic.
Karkinos.
Yeah, Mayo Clinic's first investment in the country, in India. So sometimes the timing is also important. So the location, the timing, and also the kind of the management team that you're building, the story, the vision that you are actually articulating to an investor matters. For me, there are three important things that I look at. First is, who is the founder? What is the track record of the founder? How passionate the founder is in terms of scaling up? Or more importantly, how passionate the founder is. Does the founder really have nerves of steel during a difficult time? What is the thinking process of the founder during difficult scenarios? So that's the first thing that I look at. So half of the time, in fact, we are very, very careful about investing in the right founder. It's not about the company, it's not about the business plan, it's not about the technology, it's about the founder, because it's the people who make money for investors, number one. Number two is, we look at what is the market size, how big is the TAM. If the TAM is big, TAM stands for total addressable market. If the TAM is big, then bigger the market or bigger the problem, bigger is the market. And that's the kind of actually things that we're looking for. For example, if we have MedTech device, but a MedTech device on its own, like say if it's a microscope, I would never invest in a microscope. But if it's a microscope which basically uses light-based technology and you don't have to basically go for, say, a biopsy staining technology in a biopsy for cancer diagnosis. That's something which I would invest in because that's disruptive. Or if it's a microscope that's connected to, which addresses connected health issues, then that is something which I would invest in. So it depends on the ability of the business model to become viral over a period of time. That's the second point. And the third point is always investment is about thinking about the end at the beginning. So as an investor, I want to see how I'm going to get an exit from that investment. So what kind of timelines are we talking about? Are we talking about 4 years, 5 years, 7 years? So it's important to have that frank conversation with the founder right upfront, have that alignment put in place, because when you are an early stage investor, well, you're given all the red carpet welcome, but the moment a bigger investor comes in later or a PE investor comes in later, you're forgotten. So it is during that time that what are the terms of the agreement that you have actually agreed upon with the founder, it kicks in. And it is very vital for the investor and the founder to be transparent, to be communicative, and to be actively hands-on with each other. That's how. These are the three things that we look for before we invest in startups.
Thanks, Anand. And I think we're getting hints from the organizers that we're running out of time. So what we'll do is we'll collapse the last segment into this segment, Joseph, Shafaat. Let's talk a little bit about what kind of deals you pick and also what your view on exit is in this environment. M&A is down, the IPO market is frozen. How do you exit?
Well, I'll make it short. I could only subscribe what it was mentioned before about the three criteria. I would like to stress that Asabis does three types of deals. And also, you're going to do some examples. We are multi-stage. That means we can do seed and we can do pre-IPO. And how we do that? That's like the question. I'll be back in a minute. The second thing is that we are dual hybrid. We do biotech and we do health tech, including digital health and medtech. And we do Spain, but we do Europe and US and other regions. That doesn't mean we have to stay in Europe, US. So why we do multi-stage, and probably for the entrepreneurs in the audience and for you guys, it's probably the most important thing to understand. Otherwise, we will say no, and it's not about the company, it's about the strategy. Is that seed needs to be close to Asabis. That means needs to be in Barcelona, Madrid, if you wish, even Paris, okay? But that has to be seed. That means spinning out from research centers. We've done it. InBrain is a great case. We spun out a company, graphene electrodes for deep brain stimulation, going into human after 3 years this coming month. First time graphene is placed in the brain for neuromotor diseases. Great company. We seed it. We did a convertible loan. We spin it out. We raised 20 million euros from different investors, including Merck, the corporate pharmaceutical company, and many others from Germany, and us leading the round, and now we're raising close to 70 million euros very, very soon, precisely to develop this. This was one sort of investment, early stage, and then becomes a Series A, Series B, etc. The other one can be Gradient in Paris, Series B, together with Sofinova. We work with them very closely. So we did do an investment in a medtech company. It was further away from Barcelona. That's Paris, not so far away, but still away. So there we co-partner. We always co-invest. In that case, we call it the round, and that is the type of company we would be looking at in Europe, but a little bit away, so more Series A, Series B. And then XR Health, virtual reality for mental health, reaching 20 million annual recurring revenues this year, 2024, with great contracts throughout the world, based in Boston. We did that with Nova Prime, with LG, HTC, hardware, healthcare, and pharma, and as lead investor still in the company based in Boston with offices in Barcelona. That's a pre-IPO type of deal, right? So we try to mingle. So in the room, you can see that if you're far away, you're from Dubai, but you are an early stage company, we have to have a local investor that invites us to that. We won't do it directly, but we will do it directly if you're close to home, right? So we can provide all the support at that early stage. I don't want to take more time, but there have other criteria, but I will just let the panelists to finish. Thanks.
Thank you, Joseph. I think, Shafaat, you have the honor of wrapping this whole thing up. So your thoughts?
Well, that's quite a responsibility, but what a great talk. I think if we go to the first one, which is where do we invest? I would completely agree with Anand. I think we have a similar strategy. To me, the integrity of the founder really comes first. And their mindset comes first, their skill set comes first. Businesses and business ideas can change, particularly when you're investing at a pre-seed or a seed stage. because you're still on the drawing board. You know, a little bit of money has gone in on the blueprints. But so there's a lot that can be done. And during that journey, 2 months, 3 months later, you might just completely evolve into something completely new. But we need to understand, today what we do is we are more like a startup aggregator. Because let's look at the numbers. More than 95% of startups just never receive funding. 70% of them fail during the first year. The balance, 2 or 3 years, they fail. Even when they go to market, they fail. So what we look for is not really a typical exit that a lot of founders tell me, hey, you put your money, we're going to do an IPO 5 years later. What's the percentage of IPOs which actually happen? What's the percentage of Series A which are actually raised? So a founder with that mindset that I'm going to give you an exit with Series A, B, C funding, you know, we don't play that game. Those games are over. They were there 10 years ago. It's history. Today, what we look for is this very simple business. This is how much is going to go into research. This is how much is going to go into market validation. This is the route to profitability, and this is the go-to-market. Okay, you're sitting here. How much do you want over the next 5 years? And I'm going to put the money down for the next 10 years if needed. But the money has to be spent wisely. You need to go green. You need to get into profitability year 2, year 3 max. If you're a research business and you're putting my money for research, please go to a university, you know, and find some kind of a grant. I mean, I'm not a grant provider here. I'm putting the money in the business. You need to understand, same healthcare sector, we can still make 20, 24% per annum in certain very simple businesses instead of us putting our money in some kind of a dream or a passion, right? So today the world has become practical. With the bleak overview, sir, that you mentioned, it is not that the investment is not there or the investors are not there or there's any kind of shortage of capital. That's not the case. The problem is we're not getting the right innovation, the right founders, and the right startups. Unfortunately, the ecosystem overall is kind of broken because, yes, there's a lot of pictures on panels. There are a lot of you guys presenting on whatnot places and spending more money on traveling and fundraising compared to just focusing on delivering something and having your social medias done. So, you know, as far as exits are concerned, things are concerned, I think the game has literally changed. People are looking for solid businesses, solid health tech innovation, solid stuff. I have invested myself in an Australian startup which started off with the telehealth back in COVID. It was relevant back then. Today, I bought the whole thing out. I was like, you know what, telehealth is not the only thing. What we are launching is free telehealth care for anybody. You pick up the phone, you press call, you get connected with my call center. You don't need to pre-register. You get connected with a doctor, you get your receipt, your prescription, everything, go to a pharmacy, get it done. No insurance needed, nothing. How do we do that? Advertisers' money. It's data. It's AI. You know, moreover, we have got over 5,000 kiosks out there, you know, which are literally touchless. You sit in the kiosk, it gives you your all vitals, you connect with the doctor through your app, get your prescription, and that's about it. Even buy insurance to a telco partner on the spot, pay weekly. That is the future, and I think we need to understand the 3 layers before I wrap up. One is the core of healthcare, including the red tapes, etc. Let's keep it the way it is, which is the brick and mortar. What you as an innovator can provide to the brick and mortar and what you can provide to the cloud operators. So these are 2 things. And the third thing is social impact. I think in the future, we're going to see more democratization of healthcare and medtech, and at the same time, more gap as well between developing countries, emerging markets, and developed countries. And I think that's where the opportunity lies to invest further. So thank you all for listening.
Fantastic, fantastic. Ladies and gentlemen, I've enjoyed myself immensely. I hope you have as well. Please put your hands together and join me in thanking our panelists.